Hello and welcome to the Estate Planning Toolbox. Thanks for taking some time out of your day to check out everything we have going on here. My name is John Connor and I am an attorney in the Trust and Estates Group of Graves Doherty, Heron and Moody, a law firm located in downtown Austin, Texas. This podcast is a client-focused podcast covering various estate planning topics, including wills and trusts, powers of attorney, corporate entities such as LLCs and limited partnerships, probate administration, and everything in between. Thanks very much for stopping by. Hello everyone and welcome back to the Estate Planning Toolbox. Today we will be starting a short series on the United States transfer tax system in which we will be discussing 1, the estate and gift tax, and 2, the generation skipping transfer tax. And the reason I want to do this is because whenever you are considering creating or updating your existing estate plan, it's important that you have a good basic understanding of the transfer tax system as it currently exists in the United States. So these 2 podcasts are going to be designed to just give you a quick overview on those, not get into too much in the weeds details of these taxes, the estate and gift tax and the generation skipping transfer tax, but instead to give you a working knowledge of those taxes so that you can have a good informed discussion with your estate planning attorney. Now, before we jump into that though, let's go ahead with today's movie quote of the day, and today's movie quote goes, "Louis, I think this is the beginning of a beautiful friendship." Just to give you a little hint, that quote is from a very old movie, but certainly one that everyone would agree is in the top 5 movies ever made, and this one may be one of the top 5 most famous quotes of all time as well. So hopefully you know the quote, but if you don't, stick around until the end of the podcast, and I will tell you exactly what movie that is from. So moving ahead now, as I mentioned, this is the first part of a 2-part series in which we will cover the U.S. transfer tax system, and so we'll start off by discussing what is the U.S. transfer tax system, and as I mentioned, that's made up of a couple of different parts. The first part being the estate and gift tax, which we will cover today, and that involves obviously the estate tax, which covers assets included in your gross estate and transfers that you make when you die, and it also includes the gift tax, which covers transfers made by you during your life, i.e. gifts. The other part of the U.S. transfer tax system is the generation skipping transfer tax. This is an additional layer of tax and has to do with transfers that you make to individuals that are more than 1 generation below your own. This would typically be grandchildren, but all of that will be covered in part 2 of this series and will be out next week. So let's start by talking about the gift tax, which, as I mentioned, will apply to transfers made by you during your life. That might be a gift of cash. It could also include gifts of really any other assets, real property, personal property, anything like that. One thing to keep in mind is that just because you make a gift does not mean you actually owe any gift tax, and that's actually for a couple different reasons. Reason number 1 is what is called the annual exclusion. That is an amount that you can give on a per beneficiary basis, and that amount in 2018 is $15,000. That amount is indexed for inflation every year. Some years it goes up. It usually stays stagnant for anywhere from 3 to 5 years, and then it'll go up. For example, last year and for the several years before that, the annual exclusion amount was $14,000, but this year it's $15,000. And as I mentioned, it is on a per beneficiary basis, which means that you can write a check or give assets in value equaling $15,000 to every single person on the planet and not pay a single dollar in gift tax. Married couples also have the ability to split their gifts, meaning that they can essentially double the annual exclusion up to $30,000 or double whatever the annual exclusion is for that year. Now, once you make a gift in excess of that annual exclusion, technically you have made a quote-unquote taxable gift. But again, that does not necessarily mean you're going to owe any tax. And that is because of the lifetime exemption amount, which is $11.18 million per person or per donor, and in the case of married couples means about $22.36 million per couple. This amount is also indexed for inflation, and we usually receive the new exemption amounts every year, usually sometime in November and December, so keep an eye out for that. I will discuss that in a future podcast whenever those exemption amounts do come out. Now, once you make a gift in excess of both the annual exclusion and the lifetime exemption amount, then you have made a taxable gift. You will owe some amount of gift tax, and you will be required to file a gift tax return. The other part of the estate and gift tax is quite obviously the estate tax. And this applies to assets that are included in your gross estate when you die, and or transfers you make at death. There is no annual exclusion for the estate tax, but there is that lifetime exemption amount that we just discussed, which is again $11.18 million per person. One interesting part of the estate tax is the married couple's ability to elect portability. And what this really means is when the first spouse dies, any leftover lifetime exemption amount can be transferred to the surviving spouse. And the way that works is the surviving spouse would file an estate tax return and elect portability for that remaining lifetime exemption amount, and whatever amount that might be, they simply add it to their lifetime exemption amount. So if we have a situation where the first spouse to die used none of their lifetime exemption amount, then the surviving spouse could have up to $22.36 million that they could make use of to transfer assets during their life or at death. Now, here's just a few other things to keep in mind in regards to the estate and gift tax. Once you get above that lifetime exemption amount and the annual exclusion amount and start making actual taxable gifts, the top tax rate for estate and gift taxes is 40%. So just keep that in mind. Also, as I've mentioned, the annual exclusion amount, that $15,000 amount, and the lifetime exemption amount, the $11.18 million, are indexed for inflation each year. The annual exclusion amount, again, usually stays stagnant for 3 to 5 years and then will go up some amount. I do not anticipate that it will go up for 2019 since it just went up this year in 2015. But the lifetime exemption amount does typically get adjusted up every year. And again, those rates are released at the end of the year, sometime in November and December, and I will do a podcast to update you on those whenever we actually get those figures. One final key piece to keep in mind with the estate and gift tax is that current exclusion amount of $15,000 and the current lifetime exemption amount of $11.18 million are not permanent. Those were put in place under the Tax Cuts and Jobs Act of 2017 and became effective on January 1 of this year, 2018, but they're going to actually sunset on December 31st, 2025, meaning that when we wake up on January 1st, 2026, the rates and the exclusion amounts will actually be based on the 2017 figures. So that will be something you want to keep in mind as we get closer and closer to that date. It is entirely possible that Congress will make these exclusions or exemptions permanent, but if they don't, they will change and will revert to the 2017 rates on December 31st, 2025. Now that we've kind of have an overview of the estate and gift tax, let's walk through a couple of quick examples so we can actually see how they work. In our first example, we have an individual with a $10 million estate, and they decide to make a $2 million gift to their child. Now, we have that annual exclusion of $15,000, and obviously the $2 million gift is well in excess of that. So we have a taxable gift, but there will be no gift tax owed because of that lifetime exemption amount. However, the lifetime exemption amount is reduced to $9,195,000, and you can see how that calculation works. We have the $11.18 million, which is reduced by the $2 million less the $15,000 annual exclusion. Do keep in mind that even though there's no gift tax owed, because this amount is in excess of the annual exclusion, this individual will need to file a gift tax return or a Form 709. One other example here, we have a married couple with a $15 million estate. When the first spouse dies, they leave their entire estate to the surviving spouse. In that case, because of the marital deduction, we will have no estate tax owed. The surviving spouse should file an estate tax return in order to elect portability. This will allow the surviving spouse to port that deceased spouse's unused lifetime exemption amount to themselves and will give the surviving spouse $22.36 million that they can use to transfer assets either during life or at their death. And so long as the surviving spouse's estate at the time of their death has a value less than their remaining lifetime exemption amount, then they may not be required to file an estate tax return when the surviving spouse dies. So just kind of in summary, today's talk was about the estate and gift tax, which includes 1, the gift tax, which covers lifetime transfers, and the estate tax, which covers testamentary transfers and or those assets that are included in an individual's gross estate. Now keep in mind we do have that annual exclusion of $15,000 and the lifetime exemption amount of $11.18 million, so that allows people to move some fairly significant assets without incurring any kind of gift tax or estate tax. Those annual exclusion amounts and the lifetime exemption amounts are indexed for inflation each year, but those amounts are also due to sunset on December 31st, 2025, at which point they will revert back to the 2017 rates. So that kind of covers everything for this part 1. Again, in part 2, we'll be covering the generation skipping transfer tax, so please be sure to check in then. Now, but before we go, here is today's movie quote of the day, and it is from Casablanca.
Louis, I think this is the beginning of a beautiful friendship.
Well, thank you all very much for stopping by. As always, here is my contact information. Please do not hesitate to call me or email me with any questions you have, or if you have any suggested topics for the Estate Planning Toolbox podcast. And be sure to check in next week when we wrap up this series on the U.S. transfer tax system when we cover the generation skipping transfer tax. See everyone next week.